What's up, everybody? Justin Conoco from Prime Real Estate. We have another pod session with my man, Jason Armstrong. And we've been, working in the city of London. We've been interacting on social media for a while. I reached out to him to get him on the episode because I think he's doing some things in the mortgage world that I think you guys need to know about. And I would love for you guys to get a little bit more insight into what that process is like. I think mortgages are one of the largest fields that is completely misunderstood by the consumers. They wait until the last minute and then they're freaking out trying to find a mortgage when they're buying a house and just accepting whatever product their bank is giving them or not really understanding the process. So I wanted to introduce you to him so you can find him on his mediums, and we'll link those in the comments below. But I also wanted to just get a view into how somebody like you gets into that business. So you are Spider-Man, you're Wolverine, you're a comic book character. How did Jason Armstrong become who he is today?
So actually I got into the mortgage industry because a couple of my clients were coming to me. I have an accounting practice as well.
Okay.
And in a matter of a couple of weeks, I had 3 clients come to me asking me for their tax information. So I started questioning why they were looking for that information. Found out it was for mortgages, and some backstory, I went into a conversation with them only to find out they weren't necessarily getting the best service and products and the right mortgage for them. So I just decided to jump in the space myself to try and service my clients a little bit further and better than what they were being treated like otherwise.
So I'm actually going to dig into that for a second because that's an interesting topic. Like, what was something that you would see that would maybe raise a red flag to make you think somebody's not getting the right product that might match their needs? Does it have to do with, the income that they're making, the savings they have? Like, what does that whole dynamic actually look like?
Yeah, so part of it was just the structuring of a mortgage. So the incorrect terms and conditions on that, a 1-year term compared to a 5-year term. And I was digging into their mortgage information with them and determining, you really don't need to go with this product over here, private mortgage, when you can actually qualify over here with your grade A banks, right?
Okay.
And another one was where the client owed CRA tax money, where the bank can't pay out a CRA debt, but there's other ways that you can structure that with different lenders to pay out that debt and get in a better financial situation. Did
you find that people might be a little bit rate sensitive? Like, all they were looking at maybe was the mortgage rate that they were getting regardless of the product?
Not necessarily.
Okay.
But that is a big factor in the mortgage industry for sure, where people are too focused on the rate. But it was just the time that was spent with the client, right? It was they were rejected for a particular mortgage but didn't know why, right?
Okay.
Nobody would actually sit down and explain to them and give them different options, because in my opinion everybody can get a mortgage. It's just a matter of what are the terms and conditions, and those terms and conditions may not be worth securing the financing for, right?
Okay.
But everybody has the ability to get financing.
That's an interesting dynamic, especially nowadays when, people will flat out just say, oh, I got turned down, and they get exasperated because it's something they don't do very often. So they think, well, you know what, they turned me down, I guess I'm done, right? So there are alternative options out there, but again, with the lending climate being what it is, consumers need to realize, what type of product or what type of lender they're dealing with is very, very important because of how long they're going to be in that relationship, the amount of money they're going to pay out to that lender too.
Yeah.
So the jump from being in the accounting world to actually becoming a mortgage broker, that education on-ramp, or what did that transfer look like for you?
To become a mortgage broker, unfortunately, it's about a weekend course.
Oh, okay.
There's a couple different options. You can do it online, you can do it weekend at Seneca, or a full week program. So the education requirements are very minimal, especially compared
Such as in real estate. It's the same thing, right?
Yeah.
Both industries. Unfortunately, the barrier to entry is fairly low, but it looks like your service delivery standards want to be a lot higher.
Exactly. For the accounting, it took me 8 years to get educated.
Yeah.
For the mortgages, it took me a week.
And do you find there's layover in between what you've learned from accounting into the actual mortgage world?
Yeah, definitely having an understanding of finances, personal taxes, it definitely plays well with the mortgage space.
And since you're on-ramp into the mortgage world, how are you settling in? Like, how are you enjoying yourself, especially given the real estate climate that we're dealing with right now?
Loving it, actually, because we've seen a big spike in values over the last couple of years.
Yeah.
Majority of my business is actually refis, not first-time home buyers or purchases. So with those refis, now there's a lot of equity within the properties that we can take out to pay out various debts, right?
Yeah.
Including CRA, including just consolidation of debt at a higher interest rate, etc.
Where do you think interest rates are going? And he doesn't have a crystal ball.
Yeah.
I love when people ask us, where's the market going? We're going to give our best opinion, but given what you've seen in the hikes over the past couple of years, what you're hearing behind closed doors, what do you think is going to happen over the next couple of years?
Right. Nobody knows exactly where it's going.
Yeah.
You can read an economist that says they're going to increase. You can read another economist that says they're going to decrease. My personal opinion is that the economy as a whole is doing actually a lot worse than what the government's portraying by the recent increase in the interest rates. But the argument that I tend to agree with right now is the government's trying to increase the interest rates so that when they realize, or when everybody else realizes, that the economy is not doing as well, they can actually bring it back.
Self-regulation, right? Like they're almost putting us in a position because people are overspending. I mean, I was at lunch today talking with a guy who does a lot of business with us, and we were just saying, like, people are buying these houses and they're over leveraging themselves and getting into positions where they're not going to be so secure. And when the collapse happened in the States, the one interesting thing I found was it was a shamble down there as far as how you can go about getting a self-declared income mortgage. And I mean, it was write down whatever you want, buy whatever property you want, where in Canada the lending restrictions were a lot tighter, which is probably what saved us when all that happened. So I agree with you in that sense that the government is almost playing a parental figure, maybe going a little bit further so they can claw it back if anything were to happen.
Well, if we look 2 years ago when the bank rate was 0.5%, right? They can't really bring that back too much, right? At 1.75, or if it goes up to 2.5, they can say, okay, our economy's not doing as well, and scale it back. Right?
Yeah, that's true.
So I think it's giving them more options. I don't necessarily don't necessarily believe that it's a reflection that our economy is doing positively.
Yeah, and so what are kind of the macroeconomic indicators that lead you to believe that our economy is not doing as well as they make it seem?
A big thing for me, just what I see doing the mortgages, is the age that I'm consolidating people with. So people that are in their 50s and 60s who are thinking about retiring, yet I'm going up to 80% loan to value on a mortgage with them, which 20 years ago those people were mortgage free
And clear,
right? So if you're not paying off those debts and maintaining the lifestyle that you've become accustomed to, in 10 years when you go to retire, all that debt's still there. How are you going to survive it?
How are you going to finance the debt is what you're saying, right? If you don't have any income coming in. And I mean, I love that in real estate people always say, oh yeah, there's passive income, buying investment properties. There's nothing passive about it, right? Like you're still working, it's still a job. And I mean, even if you're lending money, there's still a job involved in doing that too. So, it's interesting. And the one thing I heard recently, and I'd love to hear your opinion on it, was, our parents' generation was a saving generation because you could put money in the bank, you could make, 5 to 10 points on your money above inflation, and it was lucrative. Our generation, it seems like if you leave your money in the bank, you're losing money. So, people always talk about being leveraged to the point where you can redeploy that income somewhere else and make money. But how do you bridge that gap when you're going into your later years or your senior years and you want to be debt free? I mean, do you just assume the fact that you'd rather not have as much debt and not have to pay out as much money in the future? And
well, I think a lot of it just comes down to living within your means, right? Knowing what your income is and what you can actually afford with that income, right? So if we look at the housing market, a lot of the homes that are being built on the north side of the city are all these $1 million homes, right? If we look at 2016 census, London, top 1% in London, the household income is $203,000, right? To get an 80% loan on a $1 million home, you need $203,000 worth of income. So how can you be building all these homes when only the top 1% can afford it? Who's buying it, right?
Same question in the GTA and across Canada, right? Like when you look at those markets, and I always think that, I'm like, how many millionaires actually live in these cities? Like, and I mean billionaires with some of the prices that you see, right? But I guess that's a question that will only get seen as the market self-regulates. And there's definitely been a slowdown across the board in real estate across Canada. I mean, London was the only market that appreciated over the last couple months when a lot of the other markets, experienced a big slowdown, right? Like London increased 9%. But I always tell people, be wary of statistics, because a lot of times the statistics are 60 to 90 days old. I mean, they're talking stats that came out from our L-Star board, and we're one of the most forward-thinking real estate boards in the nation. But that data still had to go through a whole process of a house being listed, house being shown, house being put under contract with contingencies lifted, closing, before it actually gets registered as a closed sale through the board.
And what do those stats, you see on social media, all the monthly stats at the end, or the start of the month for the previous month, what do those stats actually mean, right? And how easy is it to skew those numbers?
It's like real estate agents saying, I was the #1 agent this month.
Yeah, based on what?
In my office on the left side of the building for the last 2 weeks on a Tuesday. Like,
yeah.
You can skew it any way you want. And like stat-wise too, it's a funny thing. Like, I'll always look at the news and I'll look at L-Star and I'll tell people, don't listen to what you read online. Talk to the people that are in the trenches doing the work, because like one day, so I mean in real estate anyways, and this isn't about real estate, but just to give you some context to what I'm saying, you'll have, inventory was down 10%, sales volume was down 25%. Well, if there was less homes to sell, then the volume was going to be lower, but the average price increased 50%. So you can always take one dovetail of any one of those stats, put it in a light, and the news is the worst for it. Well, we'll see it pop up, and it's clickbait that everything's collapsing. The soft landing's happening. It's started. There's definitely shifts that happen on a month-to-month basis, but there's nothing to say. Like you're in this with me every day. Where, sorry, I'm pointing to Nathan. He's off camera. It just feels like we're having an organic conversation. So, we'll be in this market right now giving advice based off that, but we got to forecast where we're going to be. And in February of next year, there may be some big announcements that happen and things change, and all, like say high-speed rail is official and gets announced and it's going to happen in February, we could be right back to where we were a year ago, where everything's selling 50 to 100,000 over asking. Yeah. So it's, I think what I'm taking from what you're saying is, on a personal level, irregardless of what the market's doing, put a little bit more stock into your personal profit and loss statement, and work with somebody that can help you analyze how much money you're making, how much money you should be spending, how much money you should be saving. And I think we need to get back to a saving culture where, put aside 10% of everything that you make, and let that compound interest help you build wealth, so that you don't end up like the baby boomers, right?
Yeah, get away from the buy now, pay later.
And our whole culture is built around buy now, pay later.
Yeah, and our generation tends to want exactly what our parents have today, right? We want that $600,000, $700,000 home, where they started out with a $30,000 home and built up their equity and did the whole property ladder thing, where they went in and did some work to the property to have some sweat equity, where we just want to go and buy that property today, not necessarily save for it.
We have Instagram. It goes beyond. I want a G4. You know what I mean? It's hilarious. I don't actually want a G4, but it's funny how you see, and you only see the best of other people's lives, and you compare it against the worst of your own life, and it always leads you to a place where you're wondering what you should have. But it's funny, because if you took yourself 20 years ago, or took your parents back 20 years ago and gave them what you have today, all these gadgets and everything else that we're looking at, that would be beyond satisfied compared to what they had at the time, right? So it's almost like the puck keeps going. You're trying to keep up with the Joneses, as Gary Vee likes to say. Like to find those Joneses and move them to another city, or get rid of them altogether, because they're definitely causing an issue, right?
Well, and I live in the Cedar Hollow neighborhood, and just north of us is another nice neighborhood, but probably about $100,000 to $150,000 higher price point, right? And when I got into the mortgage industry, I pulled 100 properties in that neighborhood, and 96 of the 100 had mortgages, and majority of those were between 75 and 80% loan to value. So they're not paying it down, it's just hovering. They're refining exactly at the same amount. So even though that person has a $700,000 home,
they don't.
They also, the bank does, right? Yeah. They also have a $500,000 or $550,000 mortgage on that property.
So they have debt. They don't actually have an asset.
Exactly, right? And they all have 2 vehicles that are $100,000 vehicles in their driveway, but until that's paid off, the bank owns that. Yeah. Right? Or somebody else owns that property. And that's how I kind of look at a lot of these monetary assets that we have. It's, do we really own that? Not until it's paid off. That's very true, right? It's and it is, again, I think it's conditioning. It's the ostrich effect of being able to put your head in the sand,
because you feel like you open that door and you own that property. At the end of the day, you don't pay that mortgage, the bank's going to come knocking, and then they're going to call 3 different real estate agents, and we're going to appraise that property, put it for market value, and that's how the process happens. That we never want to see that happen, right? And like I said, thankfully we live in Canada, and I truly believe it's one of the best countries in the world in terms of lending policies. Government influence in markets is a different conversation altogether. I believe, you know, capitalism, the markets will adjust themselves to a degree if you let it run its course. But that said, protecting people from, you know, overhyped habits or spending habits is something that needs to happen more often too. And where things go, you know, economy wise and everything else will yet to be seen. But I think a big takeaway from this conversation is really, you know, what would you suggest? So I was about to spit out, do a quarterly budget review, set your goals. Like, you know, if you were talking to somebody that has no background, any experience in this, like, where can they get started in doing an assessment of where they're at, or maybe where they should go?
Well, the easiest thing is to look at historically, what are you spending? What are you making? What are you spending? What are you saving? Right? So if you're looking at that, you can determine what you can actually afford.
Okay.
And I think a lot of people would be surprised at where they're spending their money. And then there's ways to improve that cash flow, right? Either taking out some of the luxuries that we're accustomed to, or consolidating debt, or different options that we can either spread that debt out, reduce the interest rate to become a more manageable level. And then, as Gary Vee says, stop caring about your neighbors. Stop caring about what everybody else thinks, right? Like, worry about yourself, and you'll be happy at the end of the day.
And nobody cares. Like, you worry so much about your neighbors, but everybody's so busy with their own lives, they don't care about you. Like, I'm sure they love you, I'm sure your friends love you and everything else too, but you know, they're worried about what's going on in their life more than they're worried about the new car that you got, maybe awesome for a day, but by then they'd be like, oh, there's Nate with his white car again, right? Your car's awesome. Not taken away from that. But you know, listen to what he's saying, right? Like, you got to focus on yourself, especially like being, you know, the age that we're at now too, where, you know, you bring children to the mix and families. Like, I'm thinking legacy for my daughter. I'm thinking, you know, how am I going to plan for the next 40 years to make sure that she's set up okay, and make sure that the family's taken care of, and, you know, making sure that the employees at my brokerage are well fed and treated well, and have a good working environment, versus me not being able to keep the lights on at the brokerage. And then we just talked about this with somebody about an hour ago, where we said, you know, the worst position to be in our business is giving people advice because you're beholden to that deal closing, right? Like, say I worked for one builder and all my eggs were in that basket, and that builder was over leveraged and had too much land and things were kind of falling apart for them. And that builder's asking me for advice, and I'm thinking, oh my gosh, my entire firm's going to collapse based off that. Am I going to give them the right advice?
You're dependent on that deal.
Exactly. And you're going to say whatever you can to make that check close, and that's not a position you want to be in, right?
And that's one of my advantages as a dual occupation.
Yeah. Because
I don't necessarily have to have that file closed tomorrow on the mortgage side, because I still have that other source of income. So it's a little bit different. I'm not as hungry for that file to close. And quite often I'll talk to clients and I'll say, this isn't the best transaction for you. This is what I recommend. I'm not going to get paid on that.
Yeah.
But I hope that you're going to come back to me in 3, 4, 5 years, and we'll work together.
It's legacy and relationship, right?
Exactly.
I love it. You're bang on, and I think all business dynamics are going that way. I think that's why big corporate companies are losing. I think that's why large, you know, slow-moving companies that spend all their marketing dollars on convincing you that their product was the best because of the advertising promo that they ripped, or the smell that they put in the grocery store, or whatever else. Yeah. Now people want to know where their coffee beans are roasted from. They want to make sure the guy they're buying their clothes from is an honest guy, and they'll pay a little bit more, right? They want to know that, you know, whatever girl's created the newest fashion trend, what her story is, right? And that's where there is a beauty, I find, to social media. I mean, we linked up because of it. Yep. You know, we were going back and forth on some things online. You reached out to me, and then we started talking, and then, you know, I started doing the pod series, and you just popped in my head. I saw one of your videos online, and that's literally why I messaged you. And then I literally was on London Inc. site yesterday, I think, and I saw their post that you won top 20 under 40. So congrats! I didn't even mention that yet on that award, because I mean, you're dynamic and you're doing some things that I haven't seen done before. So it's very interesting. That said, if I was going to pick one place for these people to go find some information out about you, or learn who Jason Armstrong is, or maybe get little tips and tricks and advice, where can they go find you?
Yeah. So the easiest thing is to come visit me. I love the interaction. I love the face-to-face.
Okay.
Yeah. Not always the most convenient for everybody, but our office is downtown on Waterloo, 465 Waterloo.
465 Waterloo. So
yeah.
we'll put that in the actual video so that you can see that.
And then LondonMortgageGroup.com.
Okay.
Yeah.
Do you have social media profiles, all that fun stuff that I can send them to? I'll put those in the links.
Yeah. So Armstrong CPA for pretty well everything.
Okay.
LinkedIn, Facebook, etc.
Awesome.
Yeah.
Instagram, that's your Instagram handle as well too, right? Because
Yes.
I think he's putting out some really good content there too. Send him questions too. Drive him to push out more content, more video too, because he's got a natural ability to do that and translate it as well too. And then how can we help you in terms of, you know, crossing that bridge or divide? Like, at what point in the transaction process do you prefer the intro to the client?
So as early as possible, right? So when you're dealing with the purchase, a lot of people think that they can qualify for a lot more than what they find out they can.
Okay.
I caution a lot of buyers that I'm dealing with to still have some conditions in the transaction. I don't know what your feeling on that is, but in addition...
Well, I'll stop you right there for a second, because I mean, that's a question a lot of people want to know. It's not necessarily my opinion. I'd love to have a financing inspection condition in every contract. I'd love to do a home sale condition in every single contract. It's just the nature of the marketplace. And if you're ending up in multiple offers, what are your options, right? And that's where a lot of times we're telling people, this is what can happen. If you want to put a condition in a contract, what I've seen is you're probably gonna have to pay $20,000 above what a firm offer is coming in at to get that.
Right.
So that's your prerogative.
Yeah.
And you know, unfortunately, some people put themselves in the situation where they go in firm and they haven't vetted the property enough to know, you know what, I'm pre-qualified for that, but the property should be worth what it's worth. And then they find out it's 50 grand under what it's worth because it didn't appraise,
right.
And they need the funds, right?
And that's where a good realtor comes in. So there's two aspects of the mortgage approval. It's the individual, but then it's also the property.
Yeah.
Right? So if you're selling a property that's 300 and it's only worth 270, I can only get you a loan to value on that 270, not necessarily at 300. So I caution people when they're going in for the multiple offers, make sure you're not overpaying, right? So from what I can see, that you're not advising clients to overpay fair market value, so they shouldn't have issues, but it's always a concern.
It's the same question that I asked you before, like where's the interest rate markets going? I mean, we don't have a crystal ball either. You don't know what the appraiser is going to say. I can get two appraisers that go through the same property and there's a $50,000 gap between what they're saying it's worth.
Yeah.
You know, they use a system and it's supposed to be consistent, but unfortunately it's not, right? So there is a little bit of art and math to everything that we do. But if you're in the home buying process, that's where you should go talk to the professional and kind of get that opinion to start with, get yourself qualified, then work with a realtor to make sure that the property you're going after qualifies. You know, ideally get a financing condition and then go through the whole process kind of start to finish. But either way, as long as you kind of take care of those end caps, you should be fairly safe, right?
Yeah, and realize that there's really no such thing as the pre-approval.
Yeah,
right?
It doesn't exist.
It doesn't exist.
Yeah.
A lot of people are out there promoting a pre-approval, but if that has no weight, no value, then the client really needs to understand that, right? So I can say, based on optimal conditions, you should qualify for 400K.
Yeah.
But if you buy a property that's not optimal, that doesn't apply. So I'm very cautious on how I relay that message to the client and with the realtor, right?
I'm selling a house for a gentleman right now, and he was working directly with his banker, and they had told him, he's like, well, they're going to give me this much money. I'm like, they're going to give you that much money if the property's worth that much loan to value. But I said, if you look at a property and the bank doesn't think it's worth that, you still need to bridge that gap. So I think education is key, and that's where you know people developing an audience and a group of people that they follow online that can give them that info is crucial. And then not being afraid to reach out. Canadians are nice; they don't like bothering people, but flipping somebody like you a quick message, you know, could lead to you saving yourself tens of thousands of dollars and a whole bunch of grief. So I appreciate your time. Thanks for coming out and just letting us pick your brain for a little bit. Congrats again on the top 20 under 40. Next week that'll be a big week for you. If there's anything we can do to help, feel free to let us know.
Thank you.
Awesome.
Greatly appreciate it.
Yeah, thanks, Jason.